To all our viewers from the United States, Korea, and around the world, welcome to Global Money Talk by Sampro TV, live from the floor of the New York Stock Exchange. And I'm your host, Remy Blaire, and you're watching our live broadcast from the financial capital of the nation here in New York City. We'll begin the hour with the market briefing and live coverage of the U.S. markets. Today, for the market briefing, I am joined by Tai Wong, independent proprietary trader. In addition, today we'll have Sang Lee, the founder of SPC Investments, to talk about how to select great investment managers. Tai, good morning to you. Thank you for joining me. Well, today is the 23rd anniversary of 9/11, and the annual remembrance ceremony took place at the 9/11 Memorial in Lower Manhattan today, Tai, and President Biden was there with Vice President Harris, and former President Trump also attended. Here at the New York Stock Exchange, we had a moment of silence before the opening bell. And what a somber moment as we mark this anniversary, Tai.
Yeah, for us, many of us of a certain age, and I wasn't working downtown. I had worked downtown for some years, but the events of that morning, and it was a morning just like this morning, a beautiful morning, not a cloud in the sky, and you know, it's seared into memory. And I remember when we had news, and I was working in a trading floor in Stamford, Connecticut, that a plane had flown into the World Trade Center. The first thing I thought of was, oh heavens, it's like 1945 all over again, when in heavy fog, Air Force pilots crashed B-25 bomber into the Empire State Building. And we went about life as nothing had changed. We're on conference calls, and then just after 9 o'clock, when that second plane went in, everybody stopped, and you know, all of a sudden it was something different. And as time went on, and we found out the news about it, the world had changed, and it reminded me of a class that I took in, at school. There was a political science named Francis Fukuyama, who wrote a book, an essay, and then a book called The End of History, for whom he's a little infamous for right now. But he had said in the early 90s that, liberal democracy is in the ascendant, and we don't have anything more to worry about. And 23 years ago today, we realized that we was a little, if not wrong, certainly a little too early.
And Tai, as you mentioned, a lot of people remember where they were the first moment they heard about these events unfolding. And all of us remember, if we were alive when 9/11 took place, we remember where we were and how the events affected all of us. And it's really hard to believe that it's already been 23 years.
I'm glad you brought up remembrance. And people who are in college now, forget people who are in high school, have no organic memory of that day. It's just sort of become history, which, if you could bring up graphic one, the high school kids in my town do something, graphic one, I think it's a number of flags actually. They do something every year, there we go, which is, really amazing. And they spend the weekend before, they put down 3,000 flags on the front lawn of the school, and and people really will slow down, they will stop, they will look, and it's a memory. I think that's important. So today of all days, that people remember what happened and the lessons that we learned from it. And some of them were tough lessons, but I think this is a great thing that the kids do every year.
Absolutely, and I think that's such a poignant photo that you're sharing with the viewing audience, because nearly 3,000 lives were lost that day, and so many lives across the country were affected by those terrorist attacks.
You're right, and recently, I think that we passed that threshold that first responders who died from 9/11 related illnesses who were working in the area is now well over 3,000. So more people have passed from related illnesses than actually passed on that day. And that number will unfortunately probably continue to climb slowly over the years.
And you think about all the first responders, all the people that came together, not just in New York City, but also in D.C. as well, Pennsylvania, on that day to respond to what happened and the complications and illnesses that ended up affecting them. So I'm glad you brought that up as well, Tai. But we are here at the New York Stock Exchange, and we did have that moment of silence here at the New York Stock Exchange to commemorate that 9/11 event 23 years ago. But we are also seeing the major U.S. stock averages in negative territory on this Wednesday morning. The Dow Jones Industrial Average is down by triple digits this morning and about 1.5% lower on the session. The NASDAQ Composite Index is lower as well, off by over 170 points or 1%. And the S&P 500 is also in negative territory, down by nearly 1.4% on the session. Now, Tai, we did get the release of the CPI data for the latest month, and it did come in mostly in line with expectations, but we saw higher shelter costs as well when it came to inflation. But of course, why are the markets down? And this does come ahead of the Fed Reserve meeting next week. So can you break this down for us?
Sure. What troubled the market, and you saw it instantly in the price action of gold, is, and gold dropped quickly, but at the end not very much, is the core inflation, which is what the Fed cares more about, because it doesn't include food, it doesn't include energy, which gasoline prices coming down because of lower oil prices have dragged down that headline CPI. But because shelter has been stubborn, and because it was higher, we got 0.3 in core. So previous to CPI, 70% of the market thought that we would have a 25 basis point cut, only 30% 50. Subsequent to that, we're probably at 90-10. There are a few stubborn holdouts who think the Fed really ought to go 50. And they may or may not be right, but it's not going to happen. So the Fed, I think, looks at it this way. At 1 or 2, remember they have a 2% target for inflation. At 1/10 or 2/10 per month, they're happy to have their foot on the accelerator. But at 3/10, it starts flashing yellow. And at 4/10, they're going to tap the brakes. As a matter of fact, if you remember early this year, people said, we're going to get 6 to 7, 8 cuts this year. And what stopped that? Because in January, February, and March, core inflation are up 4/10 every month. And the Fed said, we're not at 4/10, that's 4.8 for the year. They're not doing anything to raise. So we'll get our 25 basis points. They'll say we'll be vigilant, and more numbers like these will make them cautious. And I think this disappointment is what brought markets down. I mean, as a matter of fact, as I look at it now, the top gainers on the S&P 500, they're basically all in the red. They're the ones who have lost the least. Although I have to give to American Express, they're trying a little hard to get back into the green here. But when the entire board, as a practical matter, is in the red, it says there's just disappointment here. The other thing I would add is bonds are up, but they're only up a little bit. And the reason is I think bonds have gotten a little ahead of the market, and the 2-year at 360, 370, it's not going to go. Do we really think even 2-year rates will be down there at those levels in 2 years' time? Perhaps not. So I think the bond market may have gotten a little ahead of themselves.
So I'm glad you touched on the bond market, Tai, and mentioned that we're nearly little change today. But does that raise any concerns, especially since we're talking about this disinversion we saw in the yield curve?
I think that remains to be seen. We'll have to see how we've got a lot of supply coming out. We'll see how well the market digests this supply. But I do think we are at a short-term high. I would probably be looking to take profit if you've got a long bond position or anything that's like a long bond position, an analog like that. I would probably take a little profit. I think you might get a better chance to reload. And I think even if Powell were unusually dovish, I'm not sure it would rally that much more. And I actually see him as, next week, this time next week, or a little, this time on Wednesday, to be very measured.
Yes, hard to believe, but we're fast approaching that Fed meeting for the month of September. So from the 17th to the 18th, it'll be a 2-day meeting for the Federal Reserve, and we get that rate decision on the afternoon of the 18th, followed by Powell's comments. So a lot to look forward to as we head into next week. And before we move away from equities, I do want to take a look at financials.
Sure.
So yesterday you mentioned how financials were lower in the morning, and I do want to take a look at JP Morgan. So what's going on here, Tai?
Where is JP Morgan right? I'm sure it's down. It's a question of how much.
It does appear to be down by nearly 0.9% in New York morning trade.
So yesterday, I think about the time our broadcast was going on, the president of JP Morgan, Daniel Pinto, had made some comments to the effect that he thought that the street's projections for net interest income, which is what JP Morgan and other banks earn on the spread between where they lend money and where they can fund themselves, is far too high. He said these things are, I think it may have been, I may be paraphrasing him, but it's a little out of whack. And with rates coming lower, that spread tends to narrow for the banks. So that's why all the financials got hit so hard yesterday. And as people, perhaps if the analysts rush to say, okay, are we wrong on NII or net interest income here, and do we have to rejigger our numbers to be in line? If the president of JP Morgan is telling us we're wrong, he probably knows something, and he wants to set expectations. So when the earnings come out, actually you'll get a rally instead of a horrible surprise. So he's really setting expectations, which is smart.
And Tai, I remember this time yesterday you and I were talking and looking at the financials, and we're trying to figure out exactly why they were lower. And it was interesting because it came on the heels of the Federal Reserve capital requirements announcements, which was lower than half of what had been expected. So.
Yeah, I mean, it made sense when we saw the story after the broadcast, why financials were down so aggressively, including Bank of America, all the big banks.
And one sector I do want to shift over to right now is, so we talked about treasuries, so what's going on when it comes to commodities as well as FX and gold today? We did get some hawkish comments out from the BOJ, and we did see gains for the yen, but in terms of these sectors, what's going on today?
So the yen has continued to strengthen. It's up probably about 0.6%, 141 or so yen to the dollar. Could we see below 140? Maybe not immediately, but certainly possible. And when the yen rallies, especially if the market's trying to lean against it, dollar-yen moves can be really, really vicious. And as an old FX trader, I remember dollar-yen goes up on an escalator and comes down in an elevator. So I suspect that if we get a probe under 140, there may be stop losses there from people who are long, who are saying we like to carry trade, and the fact that we've come off so much from the highs, almost over 20 yen to the high, I think it was 162. There might be value here. If they're forced to stop out because a lot of these speculators trade on very substantial margin ratios, then you could see a strike. A much stronger yen, at least for a brief period, before more people do the carry trade and say we're still going to have 450, 475 basis points of carry in this trade. So yen strength is a very good point. Gold has been steady. It's only 1% or so below the all-time historic highs. I don't think it will get there today, certainly not with this CPI, but it is still a bull market. And in a bull market like that, you really only have two, I think, reasonable positions. You can be long or you can be flat, but it's not the time to be short. There'll be a day when it's time to be time to be short gold, but that's not today. What I would like to comment on is looks like crude oil is finally up today. It's been down, for substantially over the past week, the past month or so. I think we may have found a little bottom short term. You could argue that with the results of the debate, that's not as good for fossil fuels and carbon going forward. But and so less supply means higher crude prices. But I do think this might be just a bit of profit taking after a long run down.
And of course, Tai, we have yet to cover the debate, so let's get straight to it. So here we are a day after the first presidential debate between Trump and Harris. And both candidates were here in New York City over by One World Trade Center to commemorate the anniversary of 9/11. But of course, here we are. We've digested what the candidates spoke about, and we've been looking at some of the social media commentary as well. So interesting reactions across the board. But in terms of the issues that they spoke on, they covered a lot of ground. What did you think of the performance of both of the candidates?
Well, I was all ready with my bucket of popcorn and a big soda in front of my sofa, and I would say that I left most of the popcorn uneaten. It was. It reminded me of a boxing match where sort of two boxers would swing at each other and neither of them would connect very much. It was a performance where we thought it would be style over substance, and it certainly was that. I think the consensus is that Vice President Harris had the better of the debate. At least she sort of sounded better and calmer, where Trump is Trump. He is, he's excessive on hyperbole. He always has been. It's always the best. It's always the most beautiful. I don't think that you can change him. And I was watching some of the markets very carefully, looking at defense stocks and looking at, if we go to graphic 2, I was watching the markets while the debate was happening and right after. So here's some of the post-debate indicators. And this was, as you can tell from the timestamp, a little bit after midnight. I looked at, so the S&P futures were down, that's 0.5%. Gold was up a little bit. Bonds were up, and these were all indications. Bitcoin was down. These are all indications that the market, or whoever was trading at the time, thought that Harris got the better of the debate yesterday. Because you're going to see, because I think Trump is going to be friendlier on taxes and regulations for stocks, which is why S&P futures were down a bit, and conversely, if the stock market doesn't do as well, if the economy doesn't do as well, you would normally buy bonds, and certainly there was a little bit of bid to bonds, and Trump is a late convert to crypto, so Bitcoin was down substantially, which is I think sort of validates the premise that the vice president had a better day. But that, sorry, go ahead.
No, yes, go ahead.
But that said, and we won't know until probably next week, because I'm sure the polling folks are doing all the polls now, pre-debate, now post-debate, to see if how people felt about it, who won, and then if it would change how they voted. We'll probably get some of those results coming out perhaps as soon as the weekend, or early next week, because they usually like to do polls over sort of several days. Unfortunately, I don't know if it really moved the needle. I do think, having watched the entire thing, and at one point I said to myself, in this great republic, is this really the best we could do? Couldn't we do a little bit better? You had certainly, now I have to say, the CNN folks in the first debate played it straight. I think the ABC folks certainly leaned in one direction that has, the Trump partisans quite riled up this morning. So Trump made some points, Harris sounded better, but did it really move the needle? And one thing I was, with debates, I think you want to do most of your damage or make your points in the first half, because by the second half, unless you're a junkie like me, you've gone off to do something else, to be perfectly honest. At 11 o'clock, you're not watching this. One thing I did notice, and it struck me, was Vice President Harris had the look of sort of, it was hard to pin down, but I thought contempt during when she wasn't speaking during the first half of the debate, and contempt's just not a good look. It's not a good emotion, and it struck me. And I noticed also that she didn't do it in the second half, and I think her team probably told her to say, just be neutral when you're not speaking. So at the end of the day, I think the effect is marginal. Whether it moves the needle remains to be seen, but in a very tight election, marginal could be important, but we still have 55 days before the election.
Well, the countdown is on until the beginning of November, U.S. presidential election day here in the U.S. on November 5th. But I think some of the sentiment that you just expressed, Tai, you are not alone there. And that's really interesting, your observation of the behavior of both of the candidates. I do believe the price action we saw in terms of crypto, so unlike other markets such as the equity markets, that is something that you can keep your eyes on in terms of price action. And there were some expectations from those in the crypto camp that something might come up when it came to crypto, but we didn't hear anything from either Harris or Trump in terms of that. So
yeah, they were too busy sort of throwing mud to really talk about crypto, I think. The great thing about the crypto market, as you say, is literally it is the only 24/7 market, so you can always watch to see what the prevailing sentiment is at well, whatever, you can watch it Saturday, Saturday morning or Sunday night, wherever it is. But it is a good market in that it gives you an indication of what's going on.
And you also mentioned the first presidential debate, in which case it was Biden and then Trump. But we have come a long way this summer, and it's hard to believe everything that's happened, not just in politics, but also geopolitics and overall market volatility this summer, because it was only months ago until we heard that Biden will officially be stepping down, and then we had the attempted assassination of President Trump as well. So much has gone on, and as you mentioned, less than 60 days until that election day.
And as you say, it's been so busy that it seems, an age ago that President Biden dropped out, and and even longer that Trump was shot. And I think people forget that had that bullet been 2 centimeters to the right, it would have been maybe a different country, maybe a much more divided country. So thankfully it only grazed him and injured him. But it has been a very busy time, and the question is now, will there be another debate? And after watching yesterday, sometimes I wish, as much as a political junkie that I am, I wish, do we really need one? Are they going to say anything different? So I think Trump will not agree to one unless it's on Fox News, because he really felt that, he literally came out and said it was 3-on-1. And in some ways, he has inaccuracies, but he may be not far from the truth there. So I think if he gets it on Fox News, he'll do it. But if he doesn't, I think it'll pass, and I think the American people won't be missing very much if they do. Sad to say.
And I agree with you when it comes to the polling. We'll have to wait and see whether this did move the needle at all. I'm sure we'll find out in the coming days, as you mentioned as well. So very quickly, Tai, before we wrap it up for today, I understand that Taylor Swift, right?
Yes.
The pop star, she made her endorsement. What did you make of that?
It wasn't so much of a surprise, because I think she's made her political leanings, sort of well known, and so I think it was, everything she does is really, really planned and organized, and that's why she's such a great star. I mean, there's nothing left to chance. She waited till after the debate and endorsed Vice President Harris, which is really her right. I think her fans are I don't know how many of them vote, but we're probably voting for Vice President Harris anyway. But it's certainly interesting when you could argue that the world's biggest pop star comes right out and and makes an endorsement. You certainly wouldn't. I've taken daughters to Taylor Swift concerts, and you would not diminish anything that she does, because she has certainly a great amount of star power, and people love to see what's going on with her.
And for viewers out there who may not be familiar with actual endorsements, right? Because you think about a democracy and the voting system here in the U.S. What does it actually mean when a star endorses a candidate? It was interesting because when the DNC took place in Chicago, there were expectations that Beyonce might show up as well. But what are the implications of something like that?
I think it makes for a great story, and it gives us, folks like us something to talk about, which is great. At the end of the day, I think unless it is a great surprise, I don't know how much endorsements matter. So I think the Harris campaign, or I don't know if they work closely with the Cheneys, and Liz Cheney was famously very critical of Trump and was drummed out of office afterwards, that when you get 200 Republicans who are voting for Harris, that might be meaningful. But then the other side are going to say they're Republicans in name only rhinos. So it's good theater, but this election is going to come down to the wire, and I know it will probably be here election night, poring over the results, and hopefully it doesn't go too far after that. I think the markets would take it very badly if we had uncertainty for 10 days after the election or more.
Okay, Tai, well, we do have to wrap it up. We'll take a quick look at the markets right now. We are seeing the major stock averages come off earlier lows, but the Dow Jones Industrial Average does remain lower, down by 1.5%, while the NASDAQ Composite Index is off a session lows, but is off by about 0.8% at the 11:30 hour. And meanwhile, the S&P 500 remains lower as well and is down by 1.3%. Well, Tai, it was great having you here. I look forward to speaking with you soon.
See you tomorrow.
And coming up, I will be joined by Sang Lee, founder of SPC Investments. We'll be right back. Don't go away. Welcome back to Global Money Talk, live from the New York Stock Exchange. For today's second half hour of the show, I'm joined by Sang Lee, the founder of SPC Investments, and he will talk about selecting great investment managers. Before founding SPC Investments, Sang spent 18 years at GIC, the Singaporean Sovereign Wealth Fund, where he spent a number of years as the head of equities, external manager selection, and also helped positions in research as well as portfolio management. So thank you so much for joining me, and welcome to the New York Stock Exchange.
Thank you so much for having me here.
Well, for our viewers, can you tell us a little bit about your long and storied career?
Sure. Yeah, I just finished 25 years of working. It's been an amazing journey. The last 18 years of which at GIC, which is the Singapore Sovereign Wealth Fund. So I joined GIC in 2006 out of business school. My first job there was a equities department where I researched industrials and healthcare stocks and ran a sector portfolio. And then our team was subsumed into a bigger, a larger group, so I continued to pick stocks for about 7 years. And then thereafter, I worked in external fund management as an allocator. So there I headed an equities team. We had a global presence, and I cover long, short, and long-only managers. It was a great experience. Did it for about 5 years. And then in the last 6 years, or the final 6 years, I was able to get a position back in research. Came back and did strategic themes and long-term research. Spend most of my time on commodities and commodity equities.
Well, speaking of 25 years, that's a quarter of a century. So you've been through many market cycles as well as many different policy cycles. So I'm sure you can offer your experience to a lot of clients out there and for viewers who might be curious to know more. But what is next for you?
Yeah, so as I mentioned, I finished the first 25 years working. I'm now preparing for the next 25 years. And then in particular, I want to build a stock investment portfolio comprised of sort of the best / hidden gems from select equity managers, as well as the proverbial 10 baggers from my own research. So still in the R&D phase of it, but I think I'm getting there. And it's the first time doing something of my own, so it's exciting, but of course a lot of uncertainties.
Well, I think the market by itself is uncertain to begin with. So can you tell our viewers out there who might not be familiar with terms like hidden gems or 10 baggers, what does that actually mean?
Yeah. So market has a way of coming back, and when an investment manager figures out a particular stock, it's hidden. But then for various reasons, whether it's earnings, valuation or whatnot, it could be out of favor or it could be undiscovered. But the market has a way of finding these gems and so forth. So those are things that I want to do. At the same time, the market is a short-term mechanism. So they look at the near term, the next quarter, next 2 quarters, and sometimes omit to think about the longer-term impact. So to the extent that one can extend the time horizon and look at some of these things on a longer-term basis, and then get in early with the timing arbitrage that you have over a long period of time, you could compound your capital quite a bit.
And what about 10 bags?
Yes. Yeah, and then so 10 burgers are interesting. I mean, you think that, oh wow, we just missed AI. No, but that's not true. In any market conditions, whether in the 2000s or 90s and so forth, there were 10 baggers over a 3 to 5 year period. I thought about this a little bit and did some exercise. So, for example, there are companies that go from negative earnings to positive. There are companies that are quasi-interesting and became sort of a dominant mode. These are all companies for which these notion of 10 baggers actually apply. And well, also the fact of the matter is, a lot of these 10 baggers, they go straight and then they actually go down 80% before going up 10 bagger, or they do nothing for 8.5 years and then in the last year and a half it goes up. So there is a need for understanding the dynamics of how things play out, whether in business or sort of the market structure. And with the timing arbitrage that we have, I think that's something that we can try to make it happen.
And since you've been in this business, in this space for 25 years, I'm sure you can walk us through examples, because I can think of several names that might fit into this category, whether we're talking about potential hidden gems or 10 baggers. But can you walk us through any companies that come to mind?
Yeah, so for example, I mean, definitely NVIDIA, definitely Amazon. These are all companies that became 10 baggers. Or even look at Microsoft or Adobe. The way I think about these companies are, well, they started as a product or two, but then because they became part of a bigger driver for the consumer, it's one where absolutely needed. For example, Apple. So in the first instance, when Apple first came out, a lot of people had issues about them just being a consumer products company. But later on, it became a sort of a consumable, where you have the network power as well as the definite hold in the consumer's wallet. So as Apple came out with new products and kept upgrading, and then people came on and bought more. So it became a huge, humongous earnings story, and has become a 10 bagger.
Okay, well, I do want to move on to talking about selecting stocks versus managers. So give us some insight here.
Yeah. Well, just a quick caveat is that in the institutional space, you have a lot more information to digest as well as to analyze. But I think the principles are equally applicable, so I wanted to share that. I've actually prepared a few slides, so maybe we can go through and take a look real quick. Yeah, so here I just wanted to kind of lay out sort of the 3 most important things between stocks and fund managers. So on the stock, so these are the 3 things that I feel are the most important: business, management, and valuation. So starting with the business, so what kind of business is it? What do they do? What kind of pricing power do they have? What's the margin structure? What kind of financing is required? Is the financial position sturdy? What about return on assets, return on equity, incremental ROIC? These are all questions that we all ask, when we look at these companies. And what about the positioning within the industry versus the competitors? So this is the first important factor. The second important factor is management, of course. Who runs a business? I mean, even if it's a great business, if it's not run by great management, then you could have mistakes, or you could lose market share, relatively speaking. How aligned is the management versus the everything that's out there? So the most critical analysis or the factor in determining management is actually capital allocation, how they use the funds to do so. And finally, on the valuation, yes, because we're in the business of investing, where we define as putting more money in the hopes of making more, we need to think about entry and exit. So here, we could think about intrinsic value metrics such as DCF, but also common yardsticks, multiples and yields, and so forth. Now, one interesting thing that I want to point out is the notion of what is priced in. So often, we read the newspaper and say, oh wow, this is interesting. But by the time, it's already priced in. So if the piece of information that we have, or the research that we have, is already priced in, or is already reflected in the market, then the upside potential is that much less. So I think that's something that we have to understand when it comes to valuation. Okay, and then now moving over to the right-hand side and looking at the funds. Okay, so these are the three things that I would like to focus on when it comes to fund managers. The first is investments themselves. Obviously, we're allocating to managers who are supposed to be stewards of our capital. So we have to understand how they do it, how they are able to generate profitable investment. Okay, what do they do with it, how they make it happen, what do they do with it when they find it, and then what do they manage and so forth. So that's number one. Now, factor number two would be portfolio management. It's basically a broad term for basically running the portfolio. Questions like, how do you think about position sizing? How do you think about entering and exiting the investment? What do you use? IRR, some sort of a multiples, price target. They're all different kinds of things. In addition, we have to think about, okay, what kind of guardrails do we have in terms of risk management? What happens when losses occur in a drawdown? So it's not just having a good set of investments for the manager that they have, but also the running of it that is actually critical. And then finally, number three is the overall setup. So, here we're basically looking for repeatable process and a sustaining operation. So when we allocate to managers, we're underwriting their process and making sure that they are able to generate and repeat this over and over. So if we're looking at how they can do it, and then whether the process is repeatable, and whether they're set up not only in the investment side of it, but also the business of it, the HR, front office, mid office, back office, all of that combined is whether they have a sustaining setup, as well as the good alignment of interest with the partners, with the investors, with the employees, and so forth.
Well, there are a lot of moving parts there that you just mentioned, but one thing that stood out to me is what you said about information. So all of us have access to so much information when it comes to companies, but then there's something called the financial news media, where investors out there, retail investors, might get some information. So one thing I want to ask you is, when you say something is priced in and access to information, so depending on which side of the business you're in or on, then you might have access to different reports or information that the retail investor may not. So how do you know what to focus on?
Yeah, no, it's a great question. I think fundamentally, and that's the reason why the investment is one of social media, social science, where we have to go out and figure out what other people are thinking. Yeah. So to complete the research, we have to talk to people to understand what of the information is priced into market. Classic investment philosophy, there are three parts to the market. You have the sell side that sets the market, and that has their own way of looking at things. You have the buy side that actually does the risk taking, so you have to understand what they're thinking and what their theses are. And then you have the companies who understand the industry and their results themselves. So part of it is triangulating what each of these different parties have and understand. And for retail investors, such as our audiences, including ourselves, we just got to read. There's no, there's no better way of doing it other than reading, whether it's transcript, understanding the company's positioning. We also have to understand what other people are doing in the industry and so forth.
Yeah, I think that's very key here, because when we think about publicly traded companies, names that are listed here on the New York Stock Exchange and are traded, that means the public has access to public reports, correct? Whether we're talking about quarterly or annual, any management changes that might happen to a company. So let's talk about stocks first. Tell me what you think is important when it comes to stocks.
Yeah, so as mentioned, okay, maybe I can share a bit about my own research process. It's pretty simple. So I think about it, okay, first we've got to do the research and try to figure out, what is the piece of information or understanding that I have about the company that is not available to the market or unique, whether it's a longer-term timing arbitrage or analytical or information. Okay, and then the second step that I go through is understanding, okay, how much of this is priced into the market, to get an understanding of it. And then the third part would be, okay, well, companies, scenarios, market environments all have different ways of happening. So what are the scenarios and what are the probabilities that I would assign to these different things? The fourth step would be, okay, well, it's nice to have all these scenarios and so forth. What are you going to do about it? So what is the initial positioning of it? Whether you're going to go in with a 1% position or 5% or whatnot. And then finally, how do you set the roadmap to say, okay, well, if these things were to happen, the company's tracking on okay, and then we're going to do it. If not, then then we exit and move on. So it's an integrated process and it's an iterative process of looking at the information, checking back to see what is already priced in, and going back and forth and back and forth.
And I'm very curious about your second point in terms of what is priced in. Can you walk me through how you actually go about doing that?
Yeah, so again, as I mentioned, reading is a critical part. So, for example, we read on the newspaper that so and so, some famed investor is doing this or doing that. Well, by the time they're coming into the market or that news is being reported, it's almost like saying that the trade has been made and maybe it's now in the momentum phase, or maybe it's being sold down. And that's the reason why that a lot of people read it after the fact. Right? So it's that understanding of, so it's not about the margin potentials or the valuations, but rather understanding the asymmetry of the information that we have or the research that we have to say, okay, well, is this priced in or is this not priced in? So in the example, a recent example would be AI. When AI was going gangbuster, people started thinking, and the smarter people or the folks who research early started looking at the data centers, the electricity, to say, oh my gosh, we have so much demand for AI. Where are we going to have all this electricity? So some of these utilities companies start running up. So that would be another good example of the asymmetry that I'm talking about.
Yeah, but you do need to be able to extrapolate that information and that data out there, because the thing is, having information is helpful, but when there's a wealth of information, right, on the heels of an earnings call, to sift through a transcript and to be able to understand where are the correlations, where are the relationships, and how do you actually find that asymmetry, that can be very difficult. So I do want to ask about experts when it comes to this field, and what matters when it comes to fund managers.
Yeah. Well, maybe I can show you by way of looking at the process of selecting a fund manager. So maybe we can look at the second slide that I have prepared. Yeah, so this is a typical due diligence, which I call it an articulation process. So first of all, I think you start with the fund description. I think some of the lightings are not there. Yeah. But we want to first understand the strategy. that we want to understand what the manager does is our first step in allocating funds. We try to obtain a clear view of what the manager does, the objective, what's the goal, what's the benchmark, how they're going to do it, what happens in a down year, what happens in a down month, what do they do, and triangulate all that. And in addition to that, we have to also think about the team. Who makes this happen? Who does what inside the team? How are the decisions made? And what is the process of getting the ideas onto the portfolio, which moves on to the next box, which is the portfolio itself. And here we have to think about the contents, and we have to think about the structure. What I mean by content is simply the investments. So how are the investments there? What are some of the major dominant themes? How long do they have they had it? All the usual diligence questions that we've had, and so forth. And then the overall structure. So it's sort of a slicing and dicing of it to say that, okay, well, what are some major themes embedded? What are some biases? For example, is it what's the exposure into Magnificent Seven, a particular sector or theme, and so forth. And then third, we then move into the evaluate the risk management. And here we look at the parameters, and then we look at the drawdown. So parameters such as, okay, what's the maximum position sizing, or individual position level, the top 5, top 10. There are some parameters that the fund will say that they would do, and then that they will follow. So you have to evaluate that. But more importantly, we have to look at the drawdowns. So drawdown being when things go down or things go bad, how bad, and what are the actions taken in that place. So due diligence of a fund is much more like a Columbo, a detective Columbo's work, where you just kind of get a piece of paper and ask questions, and then come around, triangulate from different angles, ask the same thing, and then at the end ask, okay, what's the next example, and so forth. And then finally, after doing all this, then you have to form a thesis, right? So to say that, okay, what are the expectations? What are the roadmap? So here's how stocks and bonds versus investment managers differ, in my view. So with companies, you have cash flow. So you could say, okay, I'm going to get in, I'm going to get out, right? But with investment managers, there's no such thing as cash flow. So we have a conversation, and we do all the reports, go through our investment committee process and say, okay, this sounds good. But then we have to say, okay, what is an expectation of the manager? What is their expected return, expected volatility? What type of drawdowns they're going to have in order to achieve the alpha that they're supposed to generate? As well as the fact that we have to establish roadmap to say, okay, well, managers could deviate from style, or it could go down depending on the market structure. So how are they going to guardrail? And to the extent that adverse events happen, what is the roadmap from the allocator perspective? And do we redeem? What kind of conversation we're going to have? It's a very iterative process. So in this sort of setup, by laying out the due diligence, I thought I'd just kind of highlight some of the important things when it comes to finding fund managers.
Yes, and I think it was very helpful for our viewers to actually bring that graphic up to see this due diligence process, and for you to walk through the individual steps and give us an overview of this. But I do want to move on to the manager. So tell us a little bit about the due diligence process of selecting fund managers in terms of strategy first.
Yeah. So that depends also on the market, right? So I'll give you an example. For example, there are certain strategies that are out there that require a particular environment. For example, let's say you're an activist manager, right? So an activist manager does a lot of things, talking to the management, using the media, proxy fights, all kinds of stuff. But a lot of the tools that they would employ require a market that's actually going up. So that would be one. Let's say that the judgment of the allocator said, oh wow, this is going to be a very volatile market. Then maybe you want somebody who can understand patterns, to say, maybe a CTA manager or somebody with a lot more momentum or pattern recognition. So these are some of the things that are nuances that we would find in selecting managers, to say, okay, well, what kind of environment that we're in, and what would be the best fit for the environment to that. And then, of course, from there, then we go into applied diligence.
And I do want to move on to something that you mentioned when it comes to portfolio as well as risk management. So can you give us a deeper dive when it comes to these 2 points?
Yeah. Well, there's no, again, its caveat is that the institutional setting is much more information. So, you know, you would gather data from the manager and then start dissecting, you know, alpha versus beta, sector exposure, you know, sector risk, and then there are all these diagnostics that you can run towards try to figure out the factors and so forth to understand the portfolio. Then, of course, talking with the managers to say, okay, you know, what is it they own, what are the common themes, and then, as I mentioned, the common diligence of, you know, going by, figuring out individual names to say, okay, this is what happened, and then kind of building a holistic picture. And then you will also talk to the team members besides the portfolio manager to say, okay, well, how does, you know, who does what, and all that jazz.
And moving on to thesis. So this is something that you went into, but can you provide a deeper look into what exactly goes into this?
So, believe it or not, my own view of manager selection is much more like a fixed income analysis, where rather than equities analysis. So in equities, you know, we say, okay, well, you know, what are the conditions today, and then what good things could transpire in the future. Whereas in fixed income, you know, the highest you can get is 100, right? Now, with the manager selection, the way I think of it is, well, we want to make sure that they get to repeat the investment process in a good, sustainable setup over and over and over again. So to me, in that sense, manager selection is a little bit like a fixed income analysis rather than an equities analysis. Now, going back to the thesis, yes, then you're trying to identify what are the specific things. You know, for example, it's a great portfolio manager with a track record. It's a firm that has a lot of reach and network to be able to triangulate different ideas that they have. It's a great risk management setup where, you know, for example, the multi-manager platforms would have different risk parameters that they have to, you know, work with. So we're looking for things that are unique to them, that we believe can be the engine for generating that alpha going forward. And then, of course, as I mentioned, you have to think about the risk, and then you also have to establish the roadmap.
So you mentioned all these moving parts, and there are a lot of moving parts, and we know that this is very time-intensive, knowledge as well as labor-intensive. So when you think back to your years of experience, can you walk us through an example of a successful event that comes to mind?
Yeah. So, you know, we think about the market cycles. So as I mentioned, okay, you have to first think about the overarching environment. The overarching environment is one where, you know, markets recovering after the attack, after the financial crisis. Then you would allocate funds going into that. After the election outcomes change, then, you know, you could say, well, there are, you know, different of these dynamics that favor a certain part of the sector. So, you know, you could be allocating to the sector managers. Most of the successes that I've had, or that, you know, that our teams have had, is in tech. When the new technology, sort of the notion of S-curve, and when things are changing, being able to find managers who can identify these trends and then upsize and make it happen in a big way. So getting into those managers had been profitable in the past.
And can you name exact years or any company names when you're talking about some of these cycles that you've been through?
Actually, yeah, no. So, you know, after 2016 was one period. I hesitate to name actual names.
Okay, so you mentioned AI, and in recent weeks and recent months, we've been seeing this unwinding of some of the trade, the long Mag 7 trade. But you mentioned AI, and when we take a step back, and we all know, of course, hindsight is 20/20. So when we think about the advent of the internet and how that changed when it comes to technology. Where do you think we might potentially be when it comes to artificial intelligence? Are we still in the early days or yet to see?
Yeah, I think it's still early days. I think the way I think about it is, well, you got to first invest the money in the infrastructure, and then we have to have the applications. So in the first phase, we had all the big tech companies buying all these equipment to start. And then now we're starting to see the applications of it, whether it's Copilot in Microsoft, and of course AI is already embedded in so many different industries. So there needs to be a consumer adoption that needs to happen further. And of course the market is saying, well, where are the applications, where are the ROI, return on investment? I think these are slowly happening, and it's gonna continue. So I mean, currently, people talk about, well, it's just for translation, or for selecting, or some coming up with a travel schedule, and so forth. But I think the productivity angle will be greater, and then we'll see more and more of it as years go down.
Yeah, and I'm glad you brought up productivity, because there are still questions that are unanswered in terms of how this new technology, artificial intelligence, will be applied and how it will affect industries, and not just technology, but overall in both developed as well as developing economies as well. So we will have to wait and see. So as we edge closer to the end of today's show, I do want to take a look at the investor's checklist. So first and foremost, before we wrap up, do you have some insights to share?
Yeah. So I prepared this last slide. Let's put him up. Yeah, so this is my sort of a quick and dirty checklist. It's a mental exercise that I go through before decision making. So on the left, these are the 4 questions that I ask. First question is, well, is there money to be made? So it's an obvious question that but because we're so into the weeds and trees, we often kind of forget. But it's a fundamental question that we have to say, okay, well, is there money to be made, and why is there money to be made? Is that because of the market cycle? Is that because of a new theme or investment? So these are things that I think we have to ask. It could be a particular way of investing. It could be trading manager, as I mentioned, or CTA. But anyways, the first question that we have to ask is whether really if there's money to be made. Then I think the second question we have to ask is, what kind of money is it? Is it alpha or beta? So beta, as we know, is the market, and alpha is above and beyond the market. So, for example, if in a lake, all the ducks rise together. So, it's good market. Everybody who owns or who's exposed to the stock market will go up, but that's beta. But we're looking for alpha, so above and beyond. So what is the specific thing that the manager is able to do or exploit above and beyond? Is there a particular situation or way of doing it that allows them to do so? So I think that's the second question that we have to ask. And then we have to ask about the team and the setup. So the first 2 questions will be about the money making, whereas the last 2 will be about the team itself. So the third question we have to ask is, are the best years ahead of them? Often, managers come to you or come to us because they've had a great track record. In fact, we'll say, please come back to us after X number of months or X number of years. That's great. But by the time that they've come to pitch you the idea, maybe the market environment has changed, or maybe the dynamics that allow them to generate that alpha has changed. So we have to have a fresh pair of eyes and look at it and say, okay, what is it going forward for them? So in that regard, the question is, are the best years ahead of them? So we'll do that. Okay, and then finally, since manager selection is a competitive comparables business, so we have to ask, okay, are they the best in the crowd? And then in order to do so, we have to look at many other managers in this space to do that. Now, moving on to the quickly, sort of the 3 reminders that I have for myself. So first of all, is we underwrite the process, not the outcome of the portfolio, because again, as I mentioned, it's a detective Columbo way of looking at things and say, okay, is it going to happen again? Why is it? And so forth. And And number two, in the due diligence process, we have to focus on identifying that special something. What is it that the manager is able to do over and over again? And then finally, of course, we have to be humble and avoid some of these common pitfalls. Reliance on short-term records, concentration, opinions versus facts, flash behaviors, and so forth. Since we mentioned AI, for example, if I am predisposed to growth managers, and in a growth environment, I may be saying, "Well, wow, this is great," but we have to be careful. So we have to separate what is a fact versus opinion.
Well, it was such a pleasure having you on today. Thank you so much for sharing all of your experience, your processes, as well as insights with us today.
Thank you so much.
And before we go, we will take a very quick look at the broader market. We are seeing the Dow Jones Industrial Average, NASDAQ, and S&P 500 in the red today. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Well, thank you so much for joining us, and we'll be back tomorrow. Have a great day.